As you all know, and a lot of our distributors who have supported the Select Bond Fund, Select Income Fund, and we have had a very good run in the last few years. So one of the reasons is that interest rate has been coming down, not just in the developed markets where US, Japan, Europe, all keeping their rates at close to 0%. So there has been a lot of inflows into emerging markets and Asia, and that is the markets that we are focusing on in these funds. Secondly, even within Asia, central banks were cutting rates because of what is going on in Europe and also weaker growth, no risk of inflation. And towards the end of last year, we saw that US Treasury started to move up. And one of the reasons is that growth have been picking up in US. And we do expect that US Treasuries, currently trading at about 2% for the 10 years, is going to continue to inch higher from here to about 2.3, 2.4%. So what are we going to do, and what's our expectation of returns? Last year, our funds did something like 12% for the Select Bond Fund. We don't expect that kind of returns this year, but I think we are happy and we are quite confident we can do about 5 to 7%. Right? And one of the things that we have been doing for the portfolio is, in this rising interest rate environment, we would then reduce our duration for the portfolios. I think last year our portfolio duration in general was hovering around 5 to 6 years. Now it's down to 4 years, and we intend to bring it lower to about 3 to 3.5 years. Right? And the other thing that have done well last year as well has been high yield bonds, mainly driven by Chinese property companies, because growth in the Chinese property company had a very bad correction in 2011, and because of all the tightening policies by the government. But last year we saw that high yield bonds actually rallied significantly, huge rallying. I think Chinese property companies generated about 25 to 30% returns. So we have participated in that rally. But we think that at this moment, valuation in terms of bonds, especially in the high yield space, is very, very expensive. So we have actually taken profits and just reduced our exposure to high yield to ride through this volatility.